Welcome back to another video of the Mood team. We continue with our special video series on finance and money. And today we are going to learn what is shadow banking, although the name may sound like something secret or illegal. This is just a parallel system to the traditional bank for loans to people and companies. Nothing illegal. Let's take an example to simplify the general explanation and understand how this system works, which probably most of you used without even thinking about it. Let's use simple numbers. Remember that the numbers are neither actual or real in our example, which is purely for explanatory purposes. Joe needs a loan to renovate his house. He goes to his bank and asks for a loan of X dollars. Joe is a good payer, and the bank would grant him the loan at a rate of 5% per year. Joe, however, is not satisfied and remembers that a colleague suggested to him the CCX finance company. The CCX deals with loans for real estate, cars, student loans and more. Joe shows up at CCX offices and the same loan for the same amount of X dollars would have a 3.5% interest rate. Joe as a client finds no difference between the two loans. His only interest is in having the money he needs at the lowest available cost over the same agreed period of time. So Joe for his convenience chooses to go for the CCX loans. Here is an example of shadow banking. The problem with shadow banking is how it is made or created. The banking circuit is created by people who save, and this saving goes into their bank accounts. These bank accounts are remunerated at 1%. Banks take this money, in customer accounts, and lend it to people like Joe, at a rate of 5%. The spread between account yield and loan rate is the lending banking business. The CCX works with 200 Joe having access to their loans, and these loans are transformed into a derivative financial product. Within it there will be loans whose risk will vary, as people will be different and with a different financial history, from the safest to the most risky. Obviously the greater risk will be more rewarded by customers with a worse financial history. This financial instrument will therefore be bought by someone, in this case by a pension fund, because the yield of the product on the market makes it extremely attractive. The currency of the purchase of the instrument will enter in the CCX account, which will then be able to create other loans to others Joe. Loans that will be transformed into derivatives and sold to other funds and so on. Banks have strict regulations, especially after the 2008 crash, about loans and risk management. These regulations serve as safety net for the banks and consequently for their clients. I'm talking about capitalization and specific rules just to save your deposited money. In companies like CCX, on the other hand, there is no safety net, or if there is, it is very thin due to the low or almost no regulation. Over the years, the proportion of loans distributed by banks in relation to shadow banking loans has been increased in favor of shadow banking. The main risk arises in the creation of the derivative financial assets that have debt within them. The economic situation could change into a worse one, these debts could become uncollectible and therefore waste paper. The problem would spill over to those who are the holders of the derivative securities, which could go to a value equal to zero and therefore bankrupt the funds that hold them. On the other side of the barricade, in case of lack of financial stability, there could be a shortage of funds interested in the purchase of these derivatives, putting in difficulties companies such as CCX and making their customers return to the banking world for the necessary liquidity. Thanks for watching. Please subscribe and share our video to spread our knowledge. And remember to check all the product made for you by the Mood team.